NEE has been hammered negative 20% year to date, right there at the 52-week low, offering a 2.8% yield. But is this company severely undervalued? Is this yield looking attractive with a nice yield on cost in double digits over the next few years? We're going to understand this in today's episode. We're going to look at the historical performance of NextEra Energy. We are going to jump into their income statements, look at that top line growth, as well as focusing on their bottom line, that net income. As always, we are going to take a look at the health of the balance sheet, look at their cash versus their debt. And then this is then going to lead us into their dividend safety, some very important financial metrics you need to understand before investing in NextEra Energy. And as always, we will run it through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given our margin of safety. Now, it has been hammered. It is down negative 20% year to date. If you're comparing that to the S&P 500, it is up around 15 to 16% year to date. It's right there at the 52-week low with a forward PE of 21 and this yield of 2.8%. We are going to see shortly, based on dividend yield theory, how attractive this really is. Now, for shareholders who have essentially been holding the company for the last 10 years, you would have seen growth of 234% without that dividend reinvested. So very, very attractive as an investment if you have held this over the last 10 years. And what we want to understand today is this a company that will reflect their historical performance? And is this yield something that we will expect to see in the double digits over the next few years? Now, in terms of their income statement and their top line, what do we look for? Well, 3 to 7% growth year on year. What can we see? Well, December 2018, 16.7 billion on the top line. December 2022, just shy of 21 billion. So there's been some nice growth over the last 5 years. However, when we look on a more granular level, what do we see? Well, December 2018 to 2019, a very strong jump. However, from that point to 2021, it did decrease year on year. But what we do see from 21 to 22 is another big jump. So is this inconsistency something that is regular with this company, or is this just a one-off? We will find out shortly. Now, the bottom line, the net income, how does that compare to the top line? Do they essentially follow each other? Well, December 2018, 6.6 billion on the bottom line. December 2022, 4 billion. So we can see in actual fact, the bottom line has done the opposite of what we'd expect and the opposite of the revenue. So when we look on a more granular level, again, 2018, it has decreased to 2020. Again, from 2020, it has picked up to 2022. So slight inconsistencies, and we will take a deeper look into this shortly in our financial metrics. Now, in terms of their cash versus their debt, how does that compare? How is the health of the balance sheet? Well, December 2018, 638 million. Latest quarterly report from a few weeks ago, 1.6 billion. So they are holding more cash on the balance sheet than they did over the last 5 years. So is this positive, and how does this essentially compare when we take a look at that total debt? So total debt, 37.8 billion in December 2018. Now, what do we see? Nearly double that in their latest quarterly report, 72 billion. So they are holding a significant amount of more debt, and this is significantly larger than the increase that we can see here in the cash. But how does that essentially compare when we do take a look to the dividend safety and some very important financial metrics? Straight away, dividend safety 99, making it very, very safe. Market cap 135 billion, making it a mega cap company. Now, for those that believe we're heading into a recession, well, look at this. Recession dividend, they increased it during the 07-09 period. Whilst they did have negative 9% sales, it was above the average growth rate 07-09. And again, even though the recession return was negative 31%, if you do compare it to the S&P, it did beat that, which had a negative 55% return. So positive, in my opinion, if you believe we're heading into a recession, but again, do digest that information. Straight away, 27 years of consecutive increases. Why is that significant? Well, dividend aristocrat status is given to a company that pays consecutive dividends over the last 25 years. So this is one essential reason for a positive company. So 25 years dividend aristocrat status. What else do we see? 10% double-digit increase this year, February, 12% dividend compounded annual growth over the last 5 years, and 9% over the last 20 years. Very, very strong in terms of a dividend grower, in my opinion. Why? I always say minimum 4% in other income-producing assets, dividends, and salary, because the US inflation rate over the last 40 years was 4%. Anything less, you're taking a pay cut and losing your purchasing power. Now, dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average, 2.8 versus 2.15. So this is one signal for undervaluation. However, as always, we never look at any model in isolation and we'll draw our conclusions towards the end of the episode. But one thing to note from here, this is probably the second highest yield the company has had over the last 5 years. Forward PE, again, another sign of undervaluation when the forward PE is below the 5-year average, 21 versus 28. And the sector PE, it's still higher than the sector PE for utilities at 21 versus 16. As I mentioned, it is right there at the 52-week low. However, 52-week low does not mean undervaluation. Likewise, 52-week high does not mean overvaluation. Now, earnings versus free cash flow. If you're a regular viewer, you know we only look at the free cash flow as the earnings is susceptible to manipulation by management through accounting. However, for utilities, as we can see, the earnings is more meaningful as the cash flow is negative, usually due to the capital intensive investments in utility companies. So what do we typically look for? Well, personally, 60% is one of my 7 golden dividend metrics. If you have seen my pinned YouTube video, you'll see the other 6. So below 60% is what I personally look for. Why? Because it means there is room to grow that double-digit dividend that we love to see, as we can see here. So below 60%, in my opinion, this has consistently been around 60% lower, other than 2020, 61%. And 2023 is expected to be 59%. So straight away, very, very positive. And I can see here why this dividend safety is showing 99 so far. Likewise, as I do typically prefer to look at the free cash flow per share, given this is a utility company, we will stick to the earnings per share. 124 in 2013, 290 in 2022, 316 expected in 2023. Consistent increases year on year is incredible to see in a company. It means management know what they're doing. The company is operating well. So for me, this is very, very positive to see. Then we move on to the sales growth. As I mentioned earlier, 3 to 7% is what we like to see year on year. Slight inconsistencies, as we can see here, and as we ran through in the financial statement analysis, negative 8%, 3%, 6 and 5, 4 years out of the 10. However, when we look numerically speaking, 15 billion worth of sales in 2013, 21 billion in 2022. So whilst it does increase over the long term, we can see the cyclical nature where there are a few years of increases, even higher, as we can see here, than the 3 to 7% that we look for. But then the following years, we do see negative percentages. So again, do understand that with this company. Now, typically with utilities, what we will see is the opposite of what we like to see in typical companies, where companies do share buybacks, returning excess cash to our shareholders. We see the opposite, where they issue shares and dilute yourselves as investors. However, I would say it isn't the most company that does a lot of share issuance. 1.71 billion to 1.98 over the last 10 years, I would say is not the worst, and I would not take that as a red flag indicator. ROIC, again, another one of my 7 golden dividend metrics. 10% plus is what I typically look for in companies, as it means management are able to effectively allocate that capital. However, for utilities, around 7.5%. Again, we can see they do struggle with this, with the last 5 years around 3 to 5%. So I would look to 2023 onwards to see this percentage increase higher to around the 6 to 8% that we have seen over the last 10 years. Now, operating margins, again, 18% plus for utilities. Now, whilst they have done significantly well above that over the last 10 years, we can see the last 2 years right on that threshold. So again, 2023, 2024, I would like to see this creep back up to the levels that we have seen historically. Net debt to earnings before interest, tax, depreciation, amortization, probably one of the key metrics for this company, in my opinion. This means the number of years it would take the company to pay off all their debt net of cash on hand. 5.5 is our threshold, which means 5.5 years would be what we like to see, or lower. For the large part, it has been below that. We can see 2021 and 2022 significantly higher. Yet the positive thing to note is that dividend safety score is still showing 99. with 2023 expected to be significantly lower at 4.93, which does give me some faith in this company with that dividend safety that I would personally not worry about as an investor. Here we're just showing that 57% of the company's financing in 2022 was from debt as opposed to equity. As always, if you are enjoying the episode, do smash that like button, do hit that subscribe and join the community. It does really help. And if you want to run your own companies through the stock valuation models, do grab a copy in the pinned description below. Now, the first model, Graham's valuation, we have the stock ticker NEE, earnings per share at 405 with the growth rate per analyst estimates. Now, the yield on AAA corporate bonds coming at 4.87, showing an intrinsic value of around $58. As we can see, this shows sign of overvaluation at current prices and slightly lower than the 52-week low. Now, moving on to the multiples valuation, companies in a similar sector and size, we have Ameren, Southern, Duke Energy, NextEra Energy, stock price, EPS with the P multiples. Get the average PE multiplied by the earnings per share to give a multiples valuation price of NEE at $80, showing some nice upside to the current trading price and slightly lower than the 52-week high. We then move on to the dividend discount model, a great model for this company due to the average growth rate at around 11% for this specified period. We see the yearly dividends. Forward looking, I've gone for around 6%. You could justify a higher percentage. For those that are more conservative, could justify a slightly lower percentage. As always, if you do want to play around with the DDM model, do grab a copy in the pinned description and see what your estimates and judgments would bring. This gives a $99 DDM price based on the estimates we've just gone through, again showing signs of significant undervaluation and well above that 52-week high. We then move on to the fourth and final model, the discounted cash flow model, where we have the free cash flows year on year with our growth rate and the average growth rate. With that discount rate, we get the present value of these future free cash flows and terminal value. Add that with the cash, subtract total debt, we get to our equity value. Divide that by the shares outstanding, we essentially get a DCF price of $79. Again, upside to the current trading price and within the 52-week range shown on screen. Intrinsic value is essentially the average of the four models that we have just run through. And as always, if you do enjoy the content, do hit that like button and do subscribe to join this community for these stock valuation models directly delivered to your doorstep. So we're getting the intrinsic value at $79.41 with the current trading price around $66. Now, typically margin of safety 10% for a wide moat company, strong financial metrics and good forward-looking data. This would signal a buy for around $71. Now, personally, I would suggest a much higher essential margin of safety, but you could argue 15%. So for those that were looking at 15%, this would signal that your buy price would be around $67.50. For those that are looking for a margin of safety of 20%, your acceptable buy would be around $63.53. Now, personally, this is a company that I would like to add to my portfolio. Currently, I don't have any position, but around 20% margin of safety, I do have it on the watch list at $64. And we'll start to dollar cost average into this company for all the reasons that we have gone through so far. In terms of Wall Street, well, they forecast the price over the next 12 months to hit $88.50. So what this essentially signals, if you were to lock in a price right now at around $67, you would be getting a margin of safety of 15% based on the estimates and judgments we have run through, with an upside per Wall Street of around $88.50. As always, let me know your thoughts in the comments. Is this one you hold in your portfolio? Are you looking to add, looking to sell, or purely on the sideline speculating? As always, have a great day. Don't forget to like, subscribe, catch you on the next episode, and take care.